The SEC allowed Warren Buffett to buy up a stock and conceal the news from fellow value investors. This is not typical, but on occasion, the SEC has granted Berkshire Hathaway privacy privileges so that the company can place its money before the Buffett effect takes hold. Buffett was also allowed to do this with Verizon and Chevron back in 2020. Over the past few months, Buffett has been hiding something, a secret stock, that he purposefully failed to disclose to the public in his periodic 13F filings. In case you're unaware, the Buffett effect refers to the phenomenon wherein a stock purchased by Berkshire becomes publicly known as soon as it happens. The shares rise sharply in an instant as investors flood in knowing that Warren Buffett is buying. At this point, he essentially has the ability to print money. It also makes sense that Buffett prefers to keep these new stocks under wraps in order to invest all of his money in the company before it becomes known to the public, which is what has happened this time. However, this one was already very private, having been on the list of subjects CNBC specifically intended to grill it on before the Berkshire meeting a few weeks ago. However, nothing odd happened that day, and there was no mention of it. Well, the secret is now out, as Buffett revealed in his Q1 13F filing that he holds the 9th largest position in the Berkshire portfolio. The stock in question is Chubb Limited. Prior to the Berkshire meeting, some had speculated that it might be an insurance company, since Berkshire actually discloses the cost basis of its investments in full in their Q1 filing. The cost basis for banking, insurance, and finance roles are visible, rose by a few $1 billion, while all other categories saw a decline from Q4 to Q1. As a result, some astute observers may have predicted something, though we couldn't be certain at the time. Now that we know, however, we can answer the question, what is Chubb and why is Buffett purchasing it? Well, Chubb is a multinational insurance provider offering a wide range of insurance products and services, including commercial and personal property and casualty insurance, life insurance, supplemental health insurance, and personal accident reinsurance. As I mentioned earlier, they are a worldwide company with operations in 54 countries. However, when we look at their insurance premiums by geography, we can see that 52% of their revenue comes from the U.S., with Asia coming in second at 19% and Europe, the Middle East, and Africa at 17%. This means that a large portion of their revenue comes from just the U.S. I also want to show you a little bit of business performance to show you maybe some of the positives Buffett saw in this stock. However, before I do so, let me remind you that this is just general advice, and it might not be appropriate for you. Furthermore, I do not intend to suggest that you should buy, hold, or sell the company based on what I am discussing here. That being said, you may be wondering why Buffett would be interested in this venture, as it clearly passes the circle of competence's first hurdle. Buffett began his professional life by purchasing insurance companies such as National Indemnity and Jayco. These companies have been fundamental to Berkshire Hathaway ever since he began purchasing insurance, since it fits his understanding and comfort level. The first is that the company is big enough to make a difference for Berkshire, which is important because the company's size is a hindrance these days because they want to invest billions of dollars at a time, which naturally reduces the number of companies that can make a difference for Berkshire. Buffett, for instance, wouldn't even consider looking at Chubb if its market value was only a few billion, as any investment would not have a significant enough influence on Berkshire. Fortunately, Chubb's market value is little over $100 billion. Thus, yes, it is a significant enough tick. However, based on a cursory review of the company, I also noticed that over the course of the last 10 years, the company's revenues have grown extremely consistently, with a compound annual growth rate of 11%. Operating income has also increased, and the company's net income has grown at a rate of 13.65% over the same period. In the first quarter of this year, net income increased by 13.3% year-over-year. Year-over-year increases in written premiums for property and casualty were also recorded at 13.3%, 11.1% for commercial insurance, and 19.3% for consumer insurance. The other reason is that PNC's primary business segments are currently operating at full capacity, as evidenced by the 15.4% increase in underwriting income and the 26.3% increase in life insurance premiums written. Buffett has always liked predictability and stability, and based on the company's 10-year numbers, it's clear that Chubb delivers both. In addition to growth, they also have a very strong balance sheet. I can only imagine that Buffett was pleased with what he saw because some companies can grow well over a 10-year period. But between the start and the finish, shareholders experience a bit of a roller coaster ride. The business continuously keeps a healthy level of capital and liquidity, guaranteeing that it can always fulfill its commitments to policyholders as well. However, as you can see from the company's total assets of $234.9 billion, which include $14.4 billion in investments and $61.2 billion in net loss reserves, it can also endure financial shocks. I'm certainly no insurance expert, but Chubb seems to be quite aligned with Buffett's circle of competence and investment philosophy as well. The last thing from there is really the valuation, which despite the stock being at then all-time highs clearly didn't faze Buffett. That's the money the company sets aside for future claims, and that's what Buffett always focuses on when he talks about Berkshire's cash position. He notes that while it's more than it needs to be, he will always keep at least $30 billion on the sidelines and even more in U.S. Treasuries to protect the company from a major shock where many claims need to be paid out at once. Since insurance companies are well outside of my expertise, I can't really add much flavor to the valuation. However, he did note that Chubb's price to earnings of about 11 is low compared to the company's average PE of 15 over the past 10 years, and this does seem favorable, especially given the current growth of the business. Another metric he noted is the earnings yield, which indicates what proportion of the share price is covered by the business's earnings, and that is up roughly 9%, which is obviously better than U.S. Treasuries, which are down about 5.5%. Judging by Berkshire's buy prices, Buffett clearly found them to be good enough, as they were between the average buy price in Q3 2023 of roughly $209 and a high price in Q4 at which he bought the majority of his shares. In total, Berkshire bought 8.1 million shares worth $1.7 billion by the end of September 2023. By December 23 of that same year, the position was increased to 20.1 million shares valued at $4.5 billion, and by the end of March 24, Berkshire had accumulated nearly 26 million shares of Chubb, totaling $6.7 billion, or roughly 6.4% of Chubb's total market cap. This provides some insight into why Buffett might have purchased shares in Chubb. However, I believe that the real reason why Buffett may have done so is not the statistics, but rather the company's business model. Buffett has a strong affinity for insurance companies, and the idea of float in insurance is the main driver of this. In the business, you take people's money up front, invest it, and oftentimes you may make even more money for yourself without even having to return the money to the original owners. Yes, there will undoubtedly be some claims made. Beyond the numbers and the analysis, I believe the main reason Buffett bought Chubb was because he loved the business model and it expands Berkshire's portfolio of insurance businesses. That was definitely the number one takeaway from Buffett's 13F filing. Other notable changes included that 13% reduction of Apple. However, if you're disciplined in the underwriting process and you keep that under control well for the most part, you're being given free money to invest. It's great. Buffett has in the past referred to this as the engine room of Berkshire Hathaway. In light of the fact that Apple's stock price is currently higher than any potential future tax rate hike, Buffett is content to lock in some profits at the current 21% rate. He is also willing to reduce his stake in the company because, although it may not sound very Warren Buffett-like, he has stated that he is content to hold onto more cash given the current state of the world. That was all Buffett had to say about the 13% decline in Apple stock. In other news, Buffett added 51% to his Liberty Series XM Series C position and 62% to his Series A position, suggesting that he is doubling down on that risky arbitrage opportunity. Buffett did not go into detail about what specifically worries him, but he did mention that the fiscal deficit worries him, though that was more about talking about the expected hikes in the corporate tax rate. As a quick recap, this one involves the announcement late last year that Liberty Sirius XM one of Liberty Media's tracking stocks that holds 83% of SiriusXM shares, and SiriusXM Holdings would be merging to simplify the ownership structure of SiriusXM. Given the slight differences in market capitalization between the two companies, it makes sense that as they merge into one, the value gap will close, and Berkshire is well positioned to profit from that. Ted Weschler or Buffett are in charge of this move. The last noteworthy change in the Berkshire portfolio this quarter was the 88% reduction in Paramount Global, which was interestingly addressed by Buffett himself during the Berkshire meeting a few weeks ago, because he wanted to take full responsibility for what has been a pretty terrible investment. I've heard a lot of speculation that this one was actually Ted, who actually got to meet in Omaha this year, which is pretty cool, but overall time will tell how that one plays out for Berkshire. I've read rumors that Ted or Todd were involved in this, but no, it was entirely my decision. We sold everything, and Sufford says that I should probably just delete this, since there have been rumors that we sold AI, and that it was entirely to blame for the crucial choice. Significant financial losses, which is something that happens in business too. In fact, owning Paramount forced me to consider the topic of what people do with their free time and the rules that govern operating any kind of entertainment business, be it sports, movies, or anything else. I feel like I'm smarter now than I was a few years ago, but I also feel impoverished because of the way I was able to obtain the knowledge. Yes, however, I would like to clarify that we lost money on Paramount and B, and that I did it all by myself, for the benefit of everyone. Buffett first purchased Paramount in the first quarter of 2022, probably for between $30 and $40. Today, the stock is only worth $12. This is undoubtedly, as they say, a learning experience for Buffett, but it's also one of the reasons I think so highly of him as a manager. He could have chosen to ignore the situation and, most likely, Ted or Todd would have taken the brunt of the media criticism. But the reason I appreciate Warren Buffett as a manager is that he made a conscious decision to confront the investment and accept full responsibility for it. Nevertheless, those are the main lessons to be learned from Buffett's 13F filing. Warren Buffett just made a huge $6.7 billion investment in Chubb Insurance Company. This monumental move by one of the most revered investors in history underscores the growing importance and potential of the insurance sector in the financial market. As we delve into the reasons behind this significant investment, it's clear that Buffett's confidence in Chubb Insurance speaks volumes about the company's stability, growth potential, and strategic positioning within the industry. Chubb, known for its extensive range of insurance products and global reach, offers both commercial and personal insurance solutions. Buffett's $6.7 billion investment highlights his belief in the long-term profitability and resilience of Chubb's business model. The insurance industry, often considered a safe haven in volatile markets, provides consistent revenue streams through premiums and has substantial growth opportunities, especially in emerging markets. Buffett's investment strategy often focuses on companies with strong fundamentals, a robust track record, and the ability to generate substantial cash flows. Chubb fits this profile perfectly. Its commitment to innovation, customer service, and strategic acquisitions has positioned it as a leader in the insurance market. Furthermore, Chubb's disciplined underwriting and risk management practices ensure financial stability and the ability to withstand economic fluctuations. One key factor driving Buffett's decision could be Chubb's impressive financial performance. The company's consistent growth in earnings and its ability to maintain a strong balance sheet make it an attractive investment. Additionally, Chubb's proactive approach to integrating technology and improving operational efficiency aligns with Buffett's preference for companies that innovate while maintaining operational excellence. Buffett's endorsement of Chubb is also a testament to the company's management team. Effective leadership is a cornerstone of Buffett's investment philosophy, and Chubb's experienced management has demonstrated the ability to navigate complex market conditions while delivering shareholder value. This investment not only boosts confidence in Chubb's future prospects, but also signals to other investors the potential opportunities within the insurance sector. For those of you following our channel, this development serves as a crucial lesson in understanding market dynamics and the importance of strategic investments. Warren Buffett's decision to invest heavily in Chubb highlights the significance of thorough research and identifying companies with strong fundamentals and growth potential. As we analyze this investment, it's essential to recognize the value of patience and long-term thinking in building a successful investment portfolio. Buffett's move is likely to attract significant attention from institutional and retail investors alike. It emphasizes the need for diversification and the inclusion of stable, revenue-generating sectors like insurance in one's portfolio. For individual investors, this could be a signal to explore opportunities within the insurance sector and consider companies with a proven track record and strong growth prospects. In conclusion, Warren Buffett's $6.7 billion investment in Chubb Insurance Company is a powerful statement about the company's potential and the insurance sector's resilience. As always, we encourage you to stay informed and make investment decisions based on comprehensive research and analysis. This strategic move by Buffett is a reminder of the importance of focusing on long-term value and stability in your investment strategy. We appreciate you coming along on this enlightening adventure. If you found this video helpful, please hit the like button, share it with your friends and family, and don't forget to subscribe to our channel, Investing Tutorial, for more expert insights and updates on the financial markets. Your assistance enables us to keep providing you with insightful material. Until next time, happy investing.